Ever asked yourself what a wedge chart pattern is and how it can be used in Forex trading? Well, in the world of Forex, a wedge chart pattern is a significant indicator that traders use to predict future price movements. It's like a compass guiding us through the tumultuous seas of the Forex market. Imagine two trend lines on a chart, slowly converging as if to meet at a point. That's the essence of a wedge pattern. The pattern signals a pause in the current trend, a moment of indecision where traders are still deciding their next move. It's like the calm before the storm, a precursor to a potential breakout of price movement. There are two types of wedge patterns that you'll come across: the falling wedge and the rising wedge. They are like mirror images, each signaling different market conditions and potential price movements. A falling wedge is generally seen as a bullish pattern. Picture this: the pattern occurs in an upward trend, with the trend line sloping down as if pointing to the bullish market. It's like the market is taking a deep breath before continuing its upward journey. On the flip side, we have the rising wedge. This is typically a bearish pattern. It's found in a downward trend with the line sloping upward, indicating that the market might be gearing up for a further downward slide. Interestingly, these wedge patterns can serve as either continuation or reversal patterns. A continuation pattern indicates that the existing trend will continue, while a reversal pattern signals a potential change in the trend direction. The rising wedge, for example, if formed after an uptrend, usually points to a bearish reversal. But if it forms during a downtrend, it could signal a continuation of the down move. So, a wedge chart pattern is a crucial tool in Forex trading, but how exactly do we identify and trade these patterns? Let's find out. To start with, let's understand how to identify a rising wedge. This intriguing pattern is formed when the price consolidates between upward sloping support and resistance lines. The key here is that the slope of the support line is steeper than that of the resistance. This means that higher lows are being formed at a faster rate than higher highs, creating a wedge-like formation. This, my friends, is where the chart pattern gets its name from. The rising wedge is a bearish pattern that often signals a potential reversal or continuation of a downtrend. If the rising wedge forms after an uptrend, it usually indicates a bearish reversal pattern. On the other hand, if it forms during a downtrend, it could be a signal that the downward move will continue. Now let's paint a picture in your mind. Imagine seeing a pattern where the price action is forming new highs, but at a slower pace than when the price makes higher lows. This is a classic indication of a rising wedge. But here's where it gets interesting. With prices consolidating within the wedge, we know that a big move is imminent. A breakout could occur to either the top or bottom. If the price breaks downwards, it suggests that there are more traders eager to sell than buy. This could indicate that a downtrend is on the horizon. The magnitude of the price movement following the breakout is typically around the same as the height of the formation. This means that if the wedge is particularly steep or wide, we could expect a significant price move once the breakout occurs. In the world of Forex trading, the rising wedge is a pattern not to be ignored. It can provide valuable insight into market sentiment and potential price movements. So, the next time you spot this pattern, be ready with your entry orders. Now that we know how to spot a rising wedge, let's explore how to trade it. Trading a rising wedge can be an opportunity for significant gain if done correctly. This bearish chart pattern can serve as a powerful signal in your trading strategy, but it's crucial to understand how to navigate it. To start, a rising wedge forms when the price consolidates between upward sloping support and resistance lines. The slope of the support line is steeper than that of the resistance, indicating that higher lows are being formed faster than higher highs. This leads to a wedge-like formation, which is where the chart pattern gets its name. With prices consolidating, we know that a big move is coming, so we can expect a breakout to either the top or bottom. If the rising wedge forms after an uptrend, it's usually a bearish reversal pattern. On the other hand, if it forms during a downtrend, it could signal a continuation of the downward move. So, how do we trade this? Well, the key is to be ready with your entry orders. If the price breaks below the lower trend line, this is a signal to sell. Conversely, if the price breaks above the upper trend line, this could be an opportunity to buy. It's also crucial to understand when to expect a breakout. This typically happens when the price has moved about 4/5 of the way through the pattern. However, patience is key. Waiting for a confirmation of the breakout can save you from false signals. Keep in mind that the price movement after the breakout is approximately the same magnitude as the height of the formation. So be sure to set your targets and stop-loss levels appropriately. Trading a rising wedge might seem challenging, but with practice, it becomes a valuable tool in your trading arsenal. Remember, the key is to be patient, watch for the breakout, and be ready with your entry orders. Happy trading! Now let's shift our focus to the falling wedge. This is a bullish chart pattern, the mirror image of its bearish counterpart, the rising wedge. The falling wedge is characterized by two converging trend lines, both sloping downward. The top line, or resistance, is steeper than the bottom line, or support. This forms the signature wedge shape, tapering off as the price movements decrease in magnitude. The falling wedge can serve as both a reversal and continuation signal. As a reversal signal, it occurs at the bottom of a downtrend, signifying a potential upward swing. This means that the market is showing signs of bullishness, with traders betting on an increase in price. As a continuation signal, the falling wedge comes into play during an uptrend, hinting that the upward price action will continue. In this scenario, the market sentiment remains bullish, with traders expecting further price increases. The falling wedge tells us that the market is consolidating or pausing before the next big move. The narrowing of the price range, represented by the converging trend lines, indicates a decrease in market volatility. This is a sign that traders are undecided and are taking the time to assess their next move. However, this decrease in volatility is often temporary. Like the calm before the storm, this consolidation phase typically precedes a breakout, a sharp movement in price. The direction of the breakout, whether upwards or downwards, depends on a variety of factors, including market sentiment and macroeconomic indicators. To sum up, the falling wedge is a versatile pattern that can signal either a reversal or continuation, depending on its context. Its primary characteristic is the convergence of two downward-sloping trend lines, indicating a decrease in price movement and volatility. This consolidation phase often sets the stage for a breakout, a sudden and significant price movement. Identifying a falling wedge is the first step. Next, we'll look at how to trade this pattern. Once we've identified a falling wedge, it's time to trade. The falling wedge is a bullish chart pattern that typically signals a reversal or continuation of an upward trend. This pattern emerges when the price consolidates between downward sloping support and resistance lines. As these lines converge, we witness the formation of a wedge, signaling that a significant price movement is on the horizon. Let's break down how to trade a falling wedge step by step. First, ensure you have correctly identified the pattern. Look for a downward price movement followed by a narrowing price range or the formation of the wedge. Next, keep a keen eye on the support and resistance lines. When the price breaks above the resistance line, it's a strong signal that an upward price movement is about to take place. This is your cue to prepare for a long position. Remember, patience is key. Wait for the price to break out above the resistance line before entering a trade. Prematurely jumping the gun might leave you caught in a false breakout. Once the breakout occurs, it's time to determine your stop and limit levels. A good rule of thumb is to set your stop level just below the most recent low within the wedge. As for your limit level, aim for a target that's equal to the height of the wedge. This is based on the theory that the price movement following a breakout is roughly equal to the height of the pattern. Finally, keep in mind that a falling wedge is not a guarantee of an upward price movement. It's a probability. Like all trading patterns, it should be used in conjunction with other indicators and analysis techniques to increase your chances of success. With these guidelines, trading a falling wedge becomes a more straightforward task. As always, practice makes perfect. So keep honing your skills and happy trading. We've covered a lot today, so let's take a moment to recap. We dove headfirst into the world of wedge chart patterns, an essential tool for any Forex trader. These patterns are unique in that they signal a pause in the current trend, giving us key insights into potential future movements. We kicked things off by identifying a rising wedge. Remember, this occurs when price consolidates between upward sloping support and resistance lines. The steeper slope of the support line compared to the resistance indicates higher lows are being formed at a faster pace than higher highs. This leads to the characteristic wedge-like formation, hence the name. Keep in mind that a rising wedge can be either a bearish reversal pattern following an uptrend or a continuation of a downtrend. Next, we tackled the falling wedge. Much like its rising counterpart, a falling wedge can also be a reversal or continuation signal. As a reversal signal, it forms at the bottom of a downtrend, indicating an upcoming uptrend. As a continuation signal, it forms during an uptrend, implying the upward price action will resume. Unlike the rising wedge, the falling wedge is considered a bullish chart pattern. Whether it's a rising or falling wedge, the key takeaway is that the price movement after the breakout is roughly the same magnitude as the height of the formation. This valuable insight can help you make informed trading decisions and potentially maximize your profits. As with any trading strategy, it's important to remember that while these patterns can provide helpful signals, they're not foolproof. Market conditions are constantly changing, and what worked yesterday may not work tomorrow. So, always stay alert, continue learning, and adapt your strategies as needed. Remember, mastering these patterns takes time and practice. But once you do, you'll be well equipped to navigate the exciting world of Forex trading. And that brings us to the end of our discussion on wedge chart patterns. We've uncovered the secrets of both rising and falling wedges, and how they can signal either a continuation or a reversal in the market. The beauty of Forex trading lies in its dynamism. It's a constant learning journey. So take what you've learned today and start applying it. Practice is key. Try identifying these patterns in real-time charts. Make sample trades. See how these patterns play out. But remember, Forex trading, like any other form of investment, carries potential risks alongside its rewards. So always trade responsibly. Keep refining your strategies, stay patient, and don't get disheartened by losses. They are stepping stones on your path to becoming a skilled Forex trader. Keep practicing, stay patient, and you'll be on your way to becoming a skilled Forex trader. Until next time, happy trading.